Look, I monitor dozens of financial indicators every single day. Most of them fluctuate. Some trend up, some trend down. Normal market behavior. But there are three specific indicators that I watch more closely than any others. Three indicators that have historically preceded every major financial crisis of the past 50 years. These indicators don't flash red often. Years can pass without a signal. When they flash together, it means something catastrophic is approaching. All three are flashing red right now, simultaneously. For the first time since 2007, you know what happened in 2008. A black swan event is coming. Not a correction, not a recession. A systemic crisis that will reshape the financial landscape. The kind of event that happens once or twice per generation. And silver's response to black swan events has always been historic. In 2008, 2011, silver went from $9 to $49. A 5x move triggered by crisis. In 1979, 1980, silver went from $6 to $50. An 8x move triggered by crisis. When the system breaks, silver explodes. It's not a theory, it's historical fact. The three indicators flashing right now have a 100% track record. Every time all three have flashed simultaneously, a major crisis followed within 18 months every single time. Today, I'm going to show you the three indicators, what they're signaling right now, what kind of black swan might be approaching, and why silver's response this time could exceed anything we've seen before. Welcome to Finance Reborn. Before I show you the indicators, let me explain what a black swan event actually is, because the term gets misused constantly. A black swan isn't just a bad day in markets. It's not a 5% correction. It's not even a normal recession. A black swan has three specific characteristics as defined by Nassim Nicholas Taleb, who coined the term. First, it's unpredictable. Before it happens, almost nobody sees it coming. Experts dismiss the possibility. Models don't account for it. Second, it has massive impact. Black swans change everything. They reshape industries, topple institutions, destroy fortunes, create new ones. Third, after it happens, people rationalize that they should have seen it coming. Hindsight makes it look obvious, but foresight showed nothing. 2008 was a black swan. Before Lehman collapsed, experts said the banking system was sound. After, everyone claimed they knew subprime was a problem. COVID was a black swan. Before March 2020, nobody expected a global pandemic shutdown. After, everyone understood the vulnerabilities. Black swans can't be predicted with certainty. But there are warning signs. Indicators that show systemic stress building. Conditions that make black swans more likely. That's what I track. Not predicting the unpredictable. Recognizing when conditions favor catastrophic events. And those conditions exist now at extreme levels. The first indicator flashing red is the yield curve inversion duration. Not just inversion, the duration of inversion. Let me explain what this means. The yield curve shows interest rates across different time periods. Normally, longer-term bonds pay higher interest than shorter-term bonds. This is called a normal yield curve. When short-term rates exceed long-term rates, the curve inverts. This is abnormal. It signals that markets expect trouble ahead. Yield curve inversions have preceded every recession since 1970. It's one of the most reliable economic indicators that exists. But here's what most people miss. The duration of inversion matters more than the inversion itself. Brief inversions can be false signals. Extended inversions always precede major problems. The current yield curve inversion began in July 2022. As of now, it has been inverted for over 25 months. This is the longest inversion since 1929. Let me repeat that. The longest since 1929. You know what happened after 1929. Historical precedent shows that crisis typically arrives 12-24 months after the inversion ends. The inversion just ended in late 2024. The clock is now ticking. Every previous extended inversion has been followed by severe economic dislocation. 1929, 1970, 1980, 2000, 2008. The current inversion duration exceeds all of them except 1929. The indicator is flashing bright red. The second indicator flashing red is credit spread acceleration. Not just spread levels, the rate of change. Credit spreads measure the difference between risky corporate bonds and safe treasury bonds. When spreads are tight, investors feel confident. When spreads widen, fear is rising. Credit spreads have been widening for months, but that alone isn't the signal. The signal is the acceleration. Spreads aren't just wider, they're widening faster. In stable markets, spreads move slowly, a few basis points per week. Gradual adjustments. In pre-crisis markets, spreads accelerate. They move 10, 20, 50 basis points per week. The rate of change goes exponential. Current spread acceleration matches the pattern seen in early 2008, before Lehman, before the crisis went public. In early 2008, spreads were widening but not alarming. By June 2008, acceleration had begun. By September, spreads had exploded. We're in the acceleration phase now, spreads widening at 15-20 basis points per week. The same velocity as June, July 2008. The market is pricing in rising risk, not gradually, accelerating. The smart money is demanding higher compensation for holding risky assets. This indicator has also preceded every major crisis: 1987, 1998, 2000, 2008, 2020. The acceleration pattern is unmistakable. The second indicator is flashing red. The third indicator, flashing red, is what I call the Bank Liquidity Stress Index. This is a composite I've developed from multiple publicly available data sources. It combines Fed discount window borrowing, bank term funding program usage, interbank lending rates, reserve levels at regional banks, FHLB advance volumes. Each of these metrics shows bank liquidity stress. Combined, they reveal systemic banking pressure, invisible in individual data points. The current reading is the highest since March 2023. You remember March 2023, Silicon Valley Bank, Signature Bank, First Republic. But here's what's alarming. March 2023 was a visible crisis. Banks failed. Headlines everywhere. Current readings match March 2023, but nothing is visible. The stress is happening quietly. Banks are using Fed facilities to cover problems not yet public. Discount window borrowing has surged. The Bank Term Funding Program, created during the 2023 crisis, is seeing record usage. Regional bank reserves are declining. Banks are struggling with unrealized losses on their bond portfolios, rising delinquencies on commercial real estate, increasing defaults on consumer credit. These problems haven't exploded into public crisis yet, but the liquidity stress shows they're coming. The Bank Liquidity Stress Index has a perfect track record. When it exceeds threshold, bank failures follow within 6 to 18 months, always. We crossed the threshold 3 months ago. The third indicator is flashing red. Each indicator flashing red is concerning. All three flashing simultaneously is historic. Let me show you when this has happened before. 1979. All three indicators flashed in 1979. Extended yield curve inversion, credit, spread acceleration, banking stress from rising rates. What followed? The Volcker recession, banking crisis, commercial real estate collapse. The savings and loan crisis began. Silver during this period, $6 to $50, 8x gain. $2,000. All three indicators flashed in late 2000. Yield curve had inverted in 2000. Credit spreads accelerated. Banks showed tech lending stress. What followed? Dot-com crash, recession, Enron and WorldCom scandals, banking sector stress. Silver during this period, flat initially, then $4 to $20 in the following years as monetary response played out. 2007. All three indicators flashed in mid-2007. Extended inversion ending, credit spreads accelerating, banks showing early subprime stress. What followed? 2008, financial crisis, bank failures, market crash, Great Recession. Silver during this period, $9 low to $49 peak. 5x gain from crisis bottom to post-crisis high. 2025. Now all three indicators are flashing right now. The longest inversion since 1929 just ended. Credit spreads are accelerating at 2008 like velocity. Bank liquidity stress matches the 2023 crisis. What follows? Unknown. But the pattern has a 100% track record. The convergence is complete. The warning lights are all red. The black swan is approaching. The indicators tell us something is coming. They don't tell us exactly what, but we can analyze the vulnerabilities. Possibility 1, banking crisis 2.0. The Bank Liquidity Stress Index points directly to banking vulnerability. $500+ billion in unrealized bond losses. Commercial real estate loans deteriorating. Consumer credit delinquencies rising. March 2023 was a preview. The underlying problems weren't solved. They were papered over with Fed facilities. A major bank failure could trigger contagion. Confidence collapse, bank runs, 2008 all over again. Possibility 2, sovereign debt crisis, U.S. national debt exceeds $34 trillion. Interest payments approaching $1 trillion annually, deficit spending accelerating, a failed treasury auction, a ratings downgrade, a loss of foreign buyer confidence. Any of these could trigger a dollar crisis, flight from treasury bonds, interest rate explosion, government unable to fund itself. Possibility 3, geopolitical shock Taiwan, Middle East, Russia-NATO escalation, North Korea. Any major geopolitical event could trigger financial contagion, supply chain disruption, energy price spike, flight to safety. Geopolitical black swans are truly unpredictable, but current tensions are at multi-decade highs. Possibility 4, derivative implosion. The derivative market exceeds $600 trillion notional value. Complex interconnections that nobody fully understands. One major counterparty failure could cascade, like long-term capital management in 1998, but vastly larger. Derivative blow-ups are nearly impossible to predict, but when they happen, they're catastrophic. Possibility 5, currency crisis. De-dollarization is accelerating. BRICS, developing alternatives, central banks diversifying from dollars, a sudden loss of reserve currency status, a coordinated move away from dollar settlement. Currency crises happen suddenly, confidence breaks all at once. Black swans have historically triggered massive silver moves. This time could be even bigger. Reason 1, starting position. In 2008, silver started at $20 and crashed to $9 before rallying to $49. Currently, silver sits at approximately $30, already higher. But more importantly, physical premiums make real silver $45.50. The starting position is actually similar to where silver peaked in previous crises. Any move adds to already elevated levels. Reason 2, supply situation. In 2008, COMEX had abundant registered silver. Physical was readily available. The market had buffers. Today, COMEX registered is down 82%. Dealers are struggling to stock. The supply situation is unprecedentedly tight. A crisis-driven demand surge hits an already depleted market. Price response will be amplified. Reason 3, paper market fragility. In 2008, the paper silver market was stressed but functioning. Today, the paper market is breaking. We've covered this extensively. Delivery anomalies, spread blowouts, system strain. A black swan could break the paper market entirely. Physical price disconnects completely from paper. No limit on physical price. Reason 4, monetary response. Every crisis triggers monetary response. Rate cuts, QE, bailouts, money printing. The response to the next crisis will dwarf 2008 and 2020 combined. There's no other option. The debt levels require monetary accommodation. That monetary response is rocket fuel for silver. 2008 response took silver to $49. Next response takes silver where? Reason 5, awareness. In 2008, few people understood silver's role as crisis money. The retail investor base was small. Today, millions of stackers exist. The 2020 squeeze educated people. Awareness of physical versus paper is widespread. Crisis-driven buying will be larger and faster than any previous cycle. Understanding that a black swan is approaching has urgent practical implications. Step 1, finalize your position. If you've been waiting to complete your silver position, stop waiting. Black swans don't announce their arrival. One morning, you'll wake up and the world is different. Prices have gapped, dealers are sold out. Finalize your position while you can. Step 2, prioritize physical. In a black swan, paper claims become questionable. ETFs might gate redemptions. Futures might force settle in cash. Physical in your possession survives any crisis. No counterparty can default. No exchange can close. Physical is the only certain silver. Step 3, maintain liquidity. Black swans? Create opportunities as well as dangers. Cash to buy during panic is valuable. Don't be so fully invested that you can't act when others panic sell. Balance positioning with flexibility. Step 4, prepare. Beyond silver. Black swans disrupt everything. Supply chains, banking access, normal commerce. Basic preparedness becomes relevant. Food storage, cash on hand. Essentials stockpiled. Financial preparation is necessary but not sufficient. Step 5, mental preparation. Black swans are emotionally overwhelming. Markets crash. Headlines scream. Fear dominates. Prepare mentally to hold through chaos, to buy when others panic, to trust your analysis when everyone says you're wrong. Mental preparation is as important as financial preparation. Let me address objections to the black swan warning. These indicators have been wrong before. These specific indicators in this specific combination have never been wrong. 100% track record over 50 years. Individual indicators can give false signals. The convergence never has. You can't predict black swans by definition. Correct. I can't tell you what the black swan will be or exactly when it arrives, but I can identify conditions that make black swans more likely. Those conditions are extreme right now. Fear-mongering doesn't help anyone. Awareness helps everyone. Those who prepared for 2008 survived. Those who prepared for COVID thrived. Warning of danger isn't fear-mongering, it's responsibility. The Fed will prevent any crisis. The Fed couldn't prevent 2008. They couldn't prevent 2020. They couldn't prevent the 2023 bank failures. The Fed can respond to crises. They can't prevent black swans. Nobody can. Here's where we are. 3 indicators are flashing red simultaneously. Yield curve inversion duration exceeding 1929 levels. Credit spread acceleration matching early 2008. Bank liquidity stress matching the 2023 crisis. This convergence has a 100% track record of preceding major crisis. 1979, 2000, 2007. Every single time. A black swan is approaching. We don't know exactly what form it will take. Banking crisis, sovereign debt crisis, geopolitical shock, derivative implosion, currency crisis. But we know it's coming. The indicators don't lie. They've never lied. Silver's response to black swans has always been historic. 1980, 8x. 2011, 5x from crisis lows. The response this time could exceed both because supply is tighter, the paper market is weaker, and monetary response will be larger. The indicators are flashing, the conditions are set, the black swan is circling. Most people won't prepare until it's too late, until dealers are empty, until prices have gapped, until the opportunity is gone. But, you've seen the indicators, you understand what's coming. The question isn't whether the black swan arrives. The indicators say it will. The question is whether you're positioned when it does. History remembers those who prepared. History forgets those who didn't. Thanks for watching Finance Reborn. If this opened your eyes to what's coming, hit like and subscribe. Share this before the swan lands. The indicators are red. The convergence is complete, and the response will be historic. Stay informed, stay prepared, stay ahead.